When the stock is up 30% in a month, don't feel 30% smarter. Because when the stock is down 30% in a month, it's not going to feel so good to feel 30% dumber.
Elliott wave theory versus Dow theory forecasts. In the stock market, investors who like to do the trend will generally use Dow's theory and wave theory as references. Dow's theory is the originator of trend analysis, and wave theory is the product of advancing with the times on the basis of Dow's theory. Today, we'll go into detail comparing the fundamental differences between the two commonly used theories. When it comes to investing, there's no shortage of theories on what makes the market tick or what a particular market move means. The two largest factions on Wall Street are split among theoretical lines between supporters of the efficient market theory and those who believe the market can be beaten. Although this is a fundamental split, many other theories attempt to explain and influence the market, as well as the actions of investors in the market. In your opinion, do you think you have to be a financial expert to invest money? Or can anyone do it? Let us know in the comments section below. Now let's look at Elliott wave and Dow theories. Ralph Nelson Elliott developed the Elliott wave theory in the 1930s. Elliott believed that stock markets are generally thought to behave in a somewhat random and chaotic manner, traded in repetitive patterns. Elliott proposed that financial price tends to result from investors' predominant psychology. He found that swings in mass psychology always showed up in the same recurring fractal patterns or waves in financial markets. On the other hand, the Dow theory is a financial theory that says the market is an upward trend if one of its averages, like industrials or transportation, advances above a previous important high and is accompanied or followed by a similar advance in the other average. Elliott's theory somewhat resembles the Dow theory in that both recognize that stock prices move in waves. Because Elliott also recognized the fractal nature of markets, he was able to break down and analyze them in much greater detail. Fractals are mathematical structures, which on an ever smaller scale infinitely repeat themselves. Elliott discovered stock index price patterns were structured in the same way. He then began to look at how these repeating patterns could be used as predictive indicators of future market moves. The Dow theory, on the other hand, is an approach to trading developed by Charles H. Dow, who, with Edward Jones and Charles Bergstresser, founded Dow Jones and Company Incorporated and developed the Dow Jones Industrial Average in 1896. Dow fleshed out the theory in a series of editorials in the Wall Street Journal, which he co-founded. Charles Dow died in 1902, and due to his death, he never published his complete theory on the markets. But several followers and associates have published works that have expanded on the editorials. Dow believed that the stock market was a reliable measure of overall business conditions within the economy. By analyzing the overall market, one could accurately gauge those conditions and identify the direction of major market trends and the likely direction of individual stocks. The theory has undergone further developments in its 100-plus-year history, including contributions by William Hamilton in the 1920s, Robert Rea in the 1930s, and E. George Schaefer and Richard Russell in the 1960s. Aspects of the theory have lost ground. For example, its emphasis on the transportation sector, or railroads in its original form. But Dow's approach still forms the core of the modern technical analysis. On the other hand, Elliott made detailed stock market predictions based on reliable characteristics he discovered in the wave patterns. An impulse wave, which net travels in the same direction as the larger trend, always shows 5 waves in its pattern. A corrective wave, on the other hand, net travels in the opposite direction of the main trend. On a smaller scale, 5 waves can again be found within each of the impulsive waves. The next pattern repeats itself at ever smaller scales. Elliott uncovered this fractal structure in financial markets in the 1930s, but only decades later would scientists recognize fractals and demonstrate them mathematically. In the financial markets, we know that what goes up must come down, as a price movement up or down is always followed by a contrary movement. Price action is divided into trends and corrections. Trends show the main direction of prices, while corrections move against the trend. For the Dow theory, there are 6 main components. 1. The market discounts everything. The Dow theory operates on the efficient market hypothesis, EMH, which states that asset prices incorporate all available information. In other words, this approach is the antithesis of behavioral economics. Earnings potential, competitive advantage, management competence, all of these factors and more are priced into the market. even if not every individual knows all or any of these details. In more strict readings of this theory, even future events are discounted in the form of risk. 2. There are 3 kinds of primary market trends. Markets experience primary trends that last a year or more, such as a bull or bear market. Within these broader trends, they experience secondary trends, often working against the primary trend, such as a pullback within a bull market or a rally within a bear market. These secondary trends last from 3 weeks to 3 months. Finally, there are minor trends lasting less than 3 weeks, which are essentially noise. 3. Primary trends have 3 phases. According to the Dow Theory, a primary trend will pass through 3 phases. In a bull market, these are the accumulation phase, the public participation phase, and the excess phase. In a bear market, they're called the distribution phase, the public participation phase, and the panic or despair phase. 4. Indices must confirm each other. For a trend to be established, Dow postulated indices or market averages must confirm each other. This means that the signals that occur on one index must match or correspond with the signals on the other. If one index, such as the Dow Jones Industrial Average, confirms a new primary uptrend, but another index remains in a primary downward trend, traders should not assume that a new trend has begun. 5. Volume must confirm the trend. Volume should increase if the price moves in the direction of the primary trend and decrease if it moves against it. Low volume signals a weakness in the trend. For example, in a bull market, the volume should increase as the price rises and falls during secondary pullbacks. If in this example the volume picks up during a pullback, it could be a sign that the trend is reversing as more market participants turn bearish. 6. Trends persist until a clear reversal occurs. Reversals in primary trends can be confused with secondary trends. It's difficult to determine whether an upswing in a bear market is a reversal or a short-lived rally to be followed by still lower lows. The Dow Theory advocates caution, insisting that a possible reversal be confirmed. Elliott wave, on the other hand, developed different interpretations. In the 1970s, the Elliott wave principle gained popularity through the work of A.J. Frost and Robert Prechter. In their now legendary book, Elliott Wave Principle, Key to Market Behavior, the authors predicted the bull market of the 1980s. Prechter would later issue a sell recommendation days before the crash of 1987. The Elliott Wave Principle assumes that each market represents a phenomena fueled by economic flows, induced by psychological currents, and governed by natural laws. If these were missing, it would not be possible to achieve any balance, and the prices would lead to extremely disorganized fluctuations. The market must be considered a phenomena created and fed by men, and therefore permeated by irrational attitudes that characterize people's daily lives. Since the movement of the market prices is the product of human activity and therefore subject to natural rules, it tends to express recurring sequences of bullish and bearish waves, which can be traced back to a general model. Elliott wave theory relates these wave patterns to the mass psychology of investors. Their mood swings and confidence in the market create these price movement patterns, alternating between optimism and pessimism. The market does not record political, social, and economic events, but rather human reactions to these events. Elliott wave practitioners stress that simply because the market is a fractal does not make the market easily predictable. Scientists recognize a tree as a fractal, but that doesn't mean anyone can predict the path of each of its branches. In terms of practical application, the Elliott wave principle has its devotees and its detractors, like all other analysis methods. There is a clear difference between correlation and causation. Market movements can be correlated to psychological factors. However, there's no direct link between the two. Just because movements can be indicative of future security prices does not mean that traders should believe that they can predict these prices to a science. Traders using this theory should always remain up to date in the current market and world news, as well as developments within the security that they're following. Overall, Elliott's approach aimed to find a synthesis of the laws that govern natural phenomena, of which the stock market is simply an aspect. Elliott placed great importance on the systematic observation of nature in order to grasp its most significant cycles. Elliott wave represents the most famous and historically significant technical analysis tool used for trading forex and other financial markets. Understanding Elliott wave theory and its numerous variations is an asset for traders, since it's still one of the most effective technical analyses trading tools discovered to date. One of the key weaknesses is that the practitioners can always blame their reading of the charts rather than weaknesses in the theory. Failing that, there's the open-ended interpretation of how long a wave takes to complete. That said, the traders who commit to Elliott wave theory passionately defend it. Conclusively, both theories are great depending on how you look at them and what you expect. Charles Dow believed that the stock market as a whole was a reliable measure of global economic conditions, and that by analyzing the global market, it was possible to accurately assess those conditions to identify the direction of important market trends, as well as the likely direction of individual stocks. Furthermore, Charles Dow supported the common belief among all traders and technical analysts that an asset price and its resulting movements on a trading chart have all the necessary information already available and forecasted to make accurate predictions. Although a lot has changed over the past 100 years, the Dow Theory and its 6 tenets are still applicable today and are considered a valid trading strategy by many traders. Much of what we currently know about technical analysis has its roots in the Dow Theory. This is why all financial operators using technical analysis should be familiar with the 6 basic principles of the Dow Theory. Well, that's all about our video on Elliott versus Dow theories. Do you think both theories will be used for many years to come? Let us know in the comments section below.